Over the last few years, millions of people have opened trading accounts, faced with an endless wall of noise about both traditional and digital markets. Deciding where to put your capital requires aligning a market's specific mechanics with your personal psychology. Forex represents the established standard, the largest financial market in the world, processing over $6 trillion in volume every single day. Cryptocurrency is the modern alternative, a 24/7 frontier market built on decentralized digital assets. While both offer pathways to profit, this comparison matrix shows that they rely on two different mechanical engines to generate returns. The first engine is Forex, which relies heavily on structural leverage to make up for exceptionally low baseline price movement. The second engine, crypto, relies on extreme baseline asset volatility, requiring far less leverage to achieve large price swings. Deploying your capital into the wrong engine for your specific risk tolerance is the most common reason new traders lose their accounts. Operational hours create the first major divide. The Forex market runs 24 hours a day, but it strictly closes for the weekend. The primary lifestyle benefit here is that it forces downtime, protecting your weekend peace of mind. The strategic trade-off is gap risk. If global news breaks on a Saturday, you cannot react to it until the market opens on Sunday evening. This timeline chart illustrates the contrast. The cryptocurrency market operates on a continuous 24/7, 365-day cycle with no closing bells. That offers maximum flexibility, but it requires strict personal boundaries to prevent sleep disruption and constant chart watching. Your initial choice dictates whether you prioritize guaranteed downtime or uninterrupted market access. Next, we have to look at the mathematical reality of daily price movements, starting with major currency pairs like the euro to US dollar. Major Forex pairs typically move less than 1% in a single trading day. This risk matrix compares volatility against available leverage. To generate meaningful profits on movements that small, Forex traders utilize high leverage, sometimes up to 1 to 500. That puts the traditional currency market firmly in the top left quadrant, high leverage, low volatility. Contrast that baseline with cryptocurrency, where daily price swings of 10 to 20% are standard behavior. Because the underlying asset is already highly volatile, brokers heavily restrict the leverage available to crypto traders. So digital assets sit in the bottom right quadrant, massive natural volatility with low leverage. In the Forex model, high leverage strictly amplifies your minor losses just as aggressively as your minor gains. In the crypto model, extreme natural volatility drastically increases the risk of total, instant capital liquidation. You must choose your poison, managing the strict, unforgiving math of high leverage, or surviving the unpredictable, massive waves of raw asset volatility. We also have to look at the external forces that drive price action and how you analyze them. Forex is driven by central bank monetary policies, national interest rates, and global geopolitical conflicts. Success in this market requires a solid foundational grasp of traditional economics to predict highly structured, rational market reactions. Cryptocurrency is driven by underlying blockchain technology developments, network upgrades, and mass adoption rates. The unique risk with crypto analysis is that prices are frequently driven by sudden, sentiment-driven hysteria rather than rational financial metrics. This connects directly to your intellectual strengths. You have to decide if you are a macroeconomic strategist or a technological trend spotter. Beyond the charts, you have to consider the hidden environmental risks, specifically the safety of the platforms holding your capital. Forex is a mature, highly regulated environment that offers legal recourse, deposit protections, and strict broker compliance. Cryptocurrency is a frontier market. It operates with fewer consumer protections and a historical vulnerability to exchange hacks. Then there is the question of capital requirements. We need to debunk the myth that you can safely build wealth starting with only $100 in either market. The mathematical reality is that trading with a microbalance leaves you virtually zero margin to absorb standard, inevitable drawdowns. To survive the learning curve and execute proper risk management, professional educators recommend a starting balance of at least $1,000 to $2,000. Bringing these variables together into a decision tree helps clarify which environment fits your trading identity. If you demand regulation, prefer macroeconomic data, and require weekends off, you fit the macro strategist profile. If that sounds like you, your capital belongs in the Forex market. If you have a high risk tolerance, Want 24/7 market access and prefer analyzing technological trends, you fit the tech opportunist profile. If you fit that description, your capital belongs in the cryptocurrency market. A modern solution exists for advanced traders who identify with both profiles and want to diversify. Unified brokers, like FXNX with its NX1 account, allow users to trade both traditional currencies and digital assets from a single hub. But running both strategies simultaneously requires strict mental discipline to ensure that extreme crypto volatility doesn't destroy your leveraged Forex margins. Right now, evaluate your starting capital and establish a hard line on your personal risk tolerance. Test your chosen market fit in a simulated demo environment before deploying a single dollar of live capital, because the foundational law of both arenas is the same. Never speculate with capital that you cannot afford to lose entirely.